All right, let's go ahead. We'll go ahead and get started, everyone. We might have a couple more people trickle in, but that's all right. So for those of you that aren't familiar, my name's Kyle Kite. I am the Director of Financial Planning here at Klaas Financial. And I want to thank everybody for joining us today. With me on the call, we've got Nate Brybe, who is another advisor in our Klaas Financial Loves Park office. And we're happy to have James and Chip from ProVisor here. They're going to do the majority of the speaking for us and try to answer all your questions about what's going on in the mortgage market and how things have changed over the last couple of months here. It's pretty well timed, I think, for this one to pop up here. So, like I said, my name's Kyle. We've been working with ProVisor. It's one of our newer relationships, and I'll let them go through kind of what they do and how they operate and all that good stuff. But Nate, why don't you go ahead and tell people a little bit about Klaas Financial?
Yep. So for those who are not familiar, Klaas Financial has been around about 46 years now. We're founded down in Loves Park in 1976, I believe. We have two offices, one in Loves Park, Illinois, and one up in Fitchburg, Wisconsin, Madison there. So like I said, been in business 46 years. We are a fee-only financial planning firm, technically called a RIA, a registered investment advisor. So we give advice on financial planning, which encompasses cash flow planning, insurance planning, investments, risk management, retirement planning, and estate planning. So part of the cash flow planning thing is, people buy and sell homes, get mortgages and things like that. That's why we have our friends from ProVisor here today. But we mainly specialize with clients planning their retirements. That's our niche, we say. So people in their 50s and 60s looking to retire soon, they call a firm like ours to make sure they can retire on their terms and make sure they have enough saved and all things like that. So that's kind of our niche, but we do, broadly have, other areas that we focus on in financial planning, including, working with Jim and Chip here today on their mortgages too. So.
And before we turn it over to Jim and Chip, so just so everybody knows, like I said, I will have the live questions off for right now. So if you have a question as James and Chip are going through this, go ahead and enter it in the Q&A box or the chat box, and we'll try to get them answered as we can. Like I said, at the end, I'll open it up for live questions as well if something comes up as we're going through this. So James, Chip, go ahead.
Great. Well, thanks for having us. And everybody, thanks for taking time out of your afternoon to talk about finances and mortgages and money and retirement. So we're going to try to bring some value for you so it's worth your time. Thought it'd be good to know who we are and who the company is. So the company's called ProVisor, and we are an independent mortgage banking firm. We do business in Illinois, in Wisconsin, and Florida for our snowbirds who like to go down there and retire, and a couple other states across the nation. But for today's conversation, I want to just kind of share with you what differentiates ProVisor versus maybe your local bank that you have a relationship with or you have depository accounts with. So ProVisor is independent of that. We only specialize in real estate. So we consider ourselves to be expert in it. We've been in business 24 years. I am the founder, president, and CEO of the company. Last year, ProVisor did $300 million in real estate loans, and we do them with our money. So we are lending the money. We are not a broker. We like to say that we have the diversity and the options that the mortgage broker brings to the table, but we have the strength and the power of a banking platform behind it. What that means is I want to be able to control the experience for the consumer from start to finish. So we do everything from the conversation to the pre-qualification to the approval, all the way to the processing. We do the closing. We use our money to fund it with you, and then we release the servicing at a later point, or we'll transfer it, or we'll sell it to Fannie Mae or Freddie Mac, one of the two large GSEs that usually most mortgages end up with. So with that being said, what we've allowed ourselves to do is, since we are very robust, I tell people that we're like the Navy SEALs of lending. So we're very lean and mean. We have a very lean structure on purpose because we want to be able to have super tight margins, which allows us to pass the savings through to the consumer and allows them to get a better deal than their local credit union or their retail bank that they maybe have known for years. So since we specialize in that, I always tell people, if I have to micromanage you, you will not work here. We want to make sure that we only employ the best of the best. That's why we're like the Navy SEALs of lending. And one of the things that also brings value is through that is we have very low fee structure, and we have very low margins, which ultimately means you're going to get a really good deal when you're looking at borrowing money for 10, 15, or even 30 years. It's going to be a fantastic investment for you. All right. I'm the founder, like I told you, as far as that goes. Started it in my living room, and today we have 4 locations, brick and mortar locations, and we're just blessed. We got a really good company. We're very family driven. I care about my employees. They're like family to me as well. And it's just been a really blessing to be able to run this company. So I'm gonna have Chip tell a little bit about who he is, because he's been here a long time as well.
Oh, thanks, James. That was a great intro. It always is nice to hear that from you. I enjoy it. So thank you for that. Chip Nylans, I've been originating loans for 24 years. And in that 24 years, I've been under 2 management teams. Most recently, the amazing ProVisor team for over a decade. So that tells you how long we've been together. And it's just been an amazing experience to have the freedom that James gives us as individuals. And that allows us to really connect with each client, which is what we do. We're as far from order takers as you can be. So that's what I can tell you about that. I have my lovely wife of 23 years, Sarah, and my son, Noah, who's 15. Sarah and I graduated from the UW-Madison, and we live outside of Edgerton on the Rock River, and really enjoy Wisconsin and all it has to offer. So that's all good stuff. But now the elephant in the room, rising interest rates. So we know it's rising, and, regardless of what people say, it's overdue and, oh my gosh, it's doom. It's the end of times. I'm going to give you some insight as to why I think it isn't such a bad thing, or at least not quite as bad as you might be hearing out in the media. So a couple of things to know, just to kind of give a baseline. 30-year fixed mortgages in probably about 2 months have gone from 3% to 5%. That's about a 40% increase in rate. And that, when you hear that, that is a little bit scary. And what I want to tell you, though, is, people start talking about affordability. Oh my gosh, the rate's at 5. We can't afford the house we used to be, which, there's some truth in that. But I'm going to offer this up. When rates were so low, what happened is everybody rushes in to the purchase market, and supply is not there, and prices climb. Absolute havoc on supply. You talk to any realtor. So you take, just as a baseline, a $250,000 house. Remember, I'd say the good old days, even going back a year or so, maybe 2 years, a $250,000 house, somebody would put in an offer at maybe $240,000, and you'd go, boy, that's a pretty good offer, and it would get accepted. That's not the way it's been. People put a house up at $250,000, you get offers at $280,000 and beyond. So those 2 points, $240,000 and $280,000. So at $280,000, you get the 3% rate. Makes your payment, right around $1,200 on a 30-year fixed. At $240,000, at 5%, it's about $100 more. So even though the increase has gone up 40%, the monthly payment might not even hit 10% more. And so affordability and accessibility have also been affected because of lower rates. Not saying that it's not there because of higher rates, but maybe not quite as dramatic as being put out there. So that's one thing just to kind of keep in mind. It's like, should we purchase a house now that rates have gone up? Actually, over time, it might actually be a good thing. You're going to scatter the investor buyers. They've been around looking for the leverage of a lifetime. Buy the house cheap, get the cheap rate. It's going to potentially let more real buyers back in. And that's the accessibility I'm talking about. So I think it's an opportunity time to get back into the marketplace. A lot of buyers have been beaten down and feel they have no chance. So I'm hoping this might give them, an opportunity to get back in it. And remember, rising interest rates, is it not great today if you have to lock a loan? Maybe not. They're still pretty historically low. When you look, at a timetable over the last, pick a time, 20, 30, 40 years. So it's not like it's just the end of times because they're at 5%. Another thing, hopefully it'll correct this distorted marketplace and bring back some sanity to it is what we're hoping. That, will be combated with a little bit of inventory and, hopefully just a calmer marketplace. So another thing that's kind of a positive for the consumer about rising interest rates is it tends to bring back a wider array of mortgage products. So that, that's obviously a win-win for the consumer. So where I'm leading this is, so what if you don't have traditional W-2 income? James, can you expand on alternative products we have and that we might see moving forward?
Yeah. So what happens now is, when, as Chip says, rates go up, that starts to throttle back the pipeline of loans flowing through, whether it's a refi, whether it's a cash out refi, whether it's people buying houses, the whole thing's starting to slow down a little bit. So all these servicers that are out there start to say, oh my gosh, we are really slow. We're going down in our projections. If we're publicly traded, all of a sudden our stock price is falling. If you take a look at all the mortgage companies that went public in the last 2 years, and now look at their stock price today, it's fallen drastically. So everyone's freaking out. So now what happens is, when the thing that they're going to do is they're going to start to increase their tolerance for risk. So to increase the tolerance for risk, new mortgage products begin to open up. Things like debt service coverage ratios loans. So maybe you don't have a job, but you want to buy this property. So we're going to say, okay, let's look at the numbers, how cash flows. What's the debt service on this? How is this going to work? And maybe it's not a traditional type loan, but now it's getting the people who are servicing the loans more products to the consumer because there's less consumers refinancing right now or taking cash out or even buying houses per se. Part of that is, I'll give you just an example. This is a sad story. We had a lovely couple in our office, and they were just the nicest people. They had a special needs child, and they want to buy a house. They need to get out of their apartment. The special needs child has got some very loud. So they went to look at this house, and they wanted it so bad. And I wasn't my client, but as the president of the company, I said, the loan officer came to me, and I actually called the listing agent myself and said, listen, I know you're going to get a lot of offers. Please consider this one. The loan's approved. I pleaded for them. Over the weekend, this is a house, had 122 showings, had 48 accepted offers, and our client couldn't get the house. And they called us crying their eyes out on Monday. So when that happens, rates go up, that kind of slows this down a little bit. And then back to the point of alternative ways to buy property, because the lenders or the investors who are buying loans are trying to say, hey, we want to keep our revenues up. So we're going to do things like this DSCR loan. Or here's what's really popular right now for people with maybe they're not working. Maybe you're like, hey, I'm retired, but I got a couple $1 million in the bank, and we're kind of sick of this 20 below zero weather, and we want to go to Arizona or we want to go to Florida. Well, I don't have a lot of income, and my bank said, sorry, there's nothing I can do for you. A company like ProVisor, where we're independent of a Chase or a Wells or anything like that, we're going to have something that we call an asset depletion type loan. And we're saying, okay, let's take a look at how much money you have saved. Let's take a look what your distributions are. Let me talk with your financial planner and say, okay, here's what it's going to qualify for. And if they want to buy that little bit more expensive house, then you have to adjust your distribution during the underwriting process, increase that for maybe you have to increase it 10 or 15% from 3,000 to 3,500 or whatever the numbers may be. And then we can underwrite based on that as long as you have a 36-month continuance. So if the payment's $3,000 a month and you've got, at least over $100,000 in investments, that's more than 36 months. So we can use that as income. That's an alternative source of income other than going to work, getting a paycheck, or owning a business and getting dividend income or whatever. Sometimes when you retire early, it's harder to get a loan, even though you got excellent credit, you paid everything your whole life on time, and you got a bunch of cash in the bank. That sometimes happens. And we deal with that with a lot of our Floridians right now that are buying second homes, don't have the income, but they have the cash. So this is the best loan product for them right now in the marketplace. So what happens now is some people are like, okay, I don't want to touch my investments because my house, my main house in Rockford, Illinois is worth $600,000 and I don't have a mortgage on it. So I've got a couple $1 million tied up with these guys and I'd rather leave it because it's doing real well, but this house is just sitting there. And you say, well, yeah, rates were at 3. Well, now they're at 5. That's still really cheap. So if you're beating 5% or after tax advantages, maybe it's a little bit lower than that for you, you should look at a refinance. So I want Chip to kind of speak to a little bit about what's happening in the refinance market right now. Chip?
Yeah, thanks, James. So refinancing in a rising rate atmosphere. It's a couple things just to give you kind of an idea of where things are at. So what was predicted to happen in all of 2022 basically happened in the last 2 months.
Right.
So that's what's kind of given the shocker value here. The good news is values, and then obviously equity, are off the charts. So because of that spot right there gives you, why not use that equity to your advantage? Bad news, inflation is the highest since 1981. Everybody's talking about that. One thing to just know about inflation is, true, some people are hoping it's peaked, et cetera. We don't go into recession. But the core inflation, which core inflation removes energy like gas and also removes food prices, that's more in check. So that's something just to maybe keep in mind when you hear all the gloom and doom. But anyways, for refinancing, so the Fed, we've heard the Fed's increasing the benchmark rate. It's going up a half now, a half later, and a half again. So one thing about that is, so aside from the equity in the house, the Fed raising rates, it doesn't correlate like 1-to-1 with interest rates in the mortgage industry. But where it does correlate is with credit cards, auto loans, home equity, second mortgages. So when you're looking at things and the rates 3 on your mortgage and 3 on your car loan, hey, all is great. But what we could see coming down the line, and I think you're going to maybe see it sooner than later, is where mortgage rates, yeah, maybe they're at 5, 4.5, 5, whatever they end up going to. But all of a sudden now car loans are at 7, credit cards are at 10. What makes sense there to consider, or at least look at, is possible consolidation if you have those high rates. Another thing, James was talking about the house in Rockford worth $600 with no mortgage, but yet, hey, we need a place in Florida. We want a place in Arizona. Well, the equity out of the primary residence is your best tool. Be a great way to utilize the purchase for a second home. That's second homes have a little bit of hit. They're a little more risky, so often they'll have a slightly higher rate. So second home or investment, anything you can use out of your primary residence is going to not only give you an advantage, but probably be the best way to get those funds. So all this is good. We got potential refinancing. We're actually seeing refinancing not drop maybe as much as we thought because of the cash out utilizing equity. So all of this happens. And one thing to just kind of figure out where things are at, changes depending on the marketplace, is what are the fees to make all this happen? What are customary fees? What am I going to encounter? So that you can weigh and see what makes sense for you. And James, can you tell a little bit about that?
Yeah, I want to kind of elaborate on this. And fees are more than just, what's an appraisal or an underwriting. I want to go a little bit deeper for a second because something drastically changed in the fabric of lending just a couple months ago. What happened was the current administration, now this isn't a political discussion, I'm just keep presenting you the data. The current administration decided to put in a loan level pricing adjustment on second homes. So that was never done before. So you could buy a second home, the interest rate was the exact same as your primary home. The underwriting was a little bit more clunky, but the rate was the same, everything was the same. couple of months ago, they passed a law, said, you know what, everyone's leaving New York and New Jersey and wanting to go to Florida or Texas for whatever reason they're doing that. We're going to put a penalty in there. And it was a significant penalty. So there's different ways to pay for that. Chip mentioned the rate's higher. Some people want to put it into the rate for various reasons because of the tax deductions or whatever not. Other people are like, well, can I just pay the penalty in cash? The cash doesn't come to ProVisor. The cash actually goes to Fannie Mae or Freddie Mac, whoever's going to be purchasing that loan. So that's a cash penalty or a type of a fee for a second house if you wanted to keep the rate the same from your primary residence to a second home. The other thing that's going on right now is this is something that has kind of happened in the past, and history has a tendency to repeat itself. So we've got, the COVID crisis. We are dealing with, gas prices and food prices and everything like this, and inflation on the news. And as Chip mentioned, take out some key factors. It's not as bad as it seems, but it still seems bad to the average American. So what happens now is we're in a midterm election cycle. So wherever you're at, left, center, right, that isn't about that. What's happening though is whoever is in power, whether it's the right in power or the left in power, nobody wants to lose their power. So as we get closer to the elections, there's a good probability that we might see a do-over from what the Obama administration did with what's called quantitative easing. And they're thinking that as rates continue to rise here, John Q. consumer isn't going to be happy about that. So when we get closer to the election, there's been some rumors saying that there might be some currency manipulation coming through that would allow rates to be artificially pushed down for a window of time. So the party in power could go back and say, hey, we inherited a crisis. This is what happened, but we fixed it. Look at rates are falling right now. Vote for me. And that's highly probable that will happen. Obviously, I don't know for sure, but that's what the experts in this space are saying. So I would tell you to keep your antenna up for that, because if there's a dip when we get into the Q4, that might be a good time to say, hey, you know what? I need to either refinance my loan or I want to get some cash out because this is maybe a once in a long time due. So that's that. The next thing is, what does it cost to do something like this? There are fees. You have to have an appraisal most of the time, but not all the time. If you got a lot of equity and your house has been established, sometimes we can do a loan without an appraisal. That's not because we're awesome. It's because Fannie Mae and Freddie Mac have certain complicated algorithms. When they look at all the data points, they say, oh, the data that ProVisor entered is sufficient. We don't need a third-party appraisal. If it does, that's called a property inspection waiver, and some lenders have them, some lenders don't. We are signed up for that product, and it happens maybe about 15% of the time. Otherwise, you have to have a third-party fiduciary person come in. They establish the value. We don't get to pick them, and that person gets paid whether you close the loan or not. That's usually about $500. All right. Otherwise, when you're looking at doing a loan, there's a couple other things: title insurance. You have a settlement fee because a third-party company's got to administer all these funds. They want to make sure that everything's getting paid properly. So when it all shakes out, depending on what state you're in and what county you're in, it can vary. Wisconsin is less expensive than Illinois. So those of you who are in Illinois, the closing costs in Illinois are a little bit higher because they have different taxes in Illinois than Wisconsin has. In Wisconsin, you're going to be under $2,000. In Illinois, it might be closer to $3,000. So then your financial planner is going to say, well, let's take a look at the ROI for this expense. You're spending $2,000. Here's the cost of the money. They're going to say, yes, this is an excellent idea because you're going to get that money back in 7 months or 17 months or whatever the number may be. But it's definitely somebody you want to keep your financial planner in the loop with Chip and myself to make sure that this is in your best interest for long-term security. So other than that, there's really not a lot of other fees. ProVisor is a little unique. We have special pricing set up for the clients of Klaas. We don't charge a processing fee. We don't charge an underwriting fee. We don't charge you to even get a copy of your credit report. All right, it's very lean and mean, and we want them. Our commitment is to take good care of their clients and to make sure that everything goes smooth, and they do it at a very low cost. So, hopefully that helps a little bit. There's a lot of information that we shared with you today. I'm going to have Chip to see if there's anything he wants to check, if he wants to kind of like summarize some things or share some closing thoughts that we have to offer.
Well, yeah, thanks, James. One thing that, in just listening to you, that I was thinking about is we're running the lean and mean organization, which definitely helps consumers. And what we do is we don't go out and buy a bunch of radio spots and billboards. We would rather take a look at your mortgages, do a mortgage checkup once a year, once every 2 years. We'll pull the credit, we'll look at the values, we'll give you some insight. What's the worst that can happen? You know all is well and you rest better at night. If there's some options, we can start talking about them. But I feel like a lot of people don't visit their mortgage enough. And we're not trying to get you into some mortgage or sell you something. We would rather say, hey, everything looks good, stay the course. We'll talk to you again in 2 years. What we're hoping is, because of that honesty, and we're trying to get you down the path the way you want to go down it, maybe you'll think about us when the time does come, or you'll share our name with friends, family, go, hey, these guys seem like shooting straight from the hip, give them a shot. And that's all we can ask, and that's what we hope.
Yeah, because life happens. So unfortunately, when we have a client sitting in front of us and everything is well, but sometimes, people get divorced for whatever reason that is, and that's a hardship in life. And then what do you do with that large asset? If you're in a marital property state, it's handled differently than a non-marital property state. Wisconsin is a marital property state, so there's got to be certain things that take place. Illinois is more lenient in that area. So what happens with that asset now? And that's something that your planner and we want to be involved with to kind of counsel you through that. So there's no shame in that. Just sometimes bad things happen to good people. Maybe it's a medical event. Maybe your partner gets cancer, and it's like, oh my gosh, we now just ran up a bunch of medical bills and we don't know what to do. I've always had 800 credit score, and I don't really want to touch my investments because they're performing really well. But I got a house worth 750 and I only owe 48 grand on it. What should I do? So just conversations that revolve around real life. And I will tell you, if this doesn't make sense, it doesn't make sense. I mean, we are a company that was built on word of mouth, belly to belly, handshake to handshake, honor, integrity, and valor. And that is how we built it. And that is very important to us, to do the right thing every single time. But sometimes you don't know. You get lost in the cloud of the emotion of your own situation, and you have a sick child or something, and you need 50 grand or whatever it is. It's just a conversation. It doesn't cost anything. We'll do the analysis. We have all the tools at our disposal, and we can give you at least a viable option to sit down with your planner about within an hour for free. Just take the information. And if you and your financial planner say, no, we're not going to do that, no problem. We are a long-term committed partner to Klaas and all of their clients. So we want to provide data, we want to provide information, and we want to educate you and empower you so you make a good financial decision for your future, period. All right? We'd be more than glad to answer any question that you have.
Go ahead, Nate. Were you going to say something?
Well, I had a few questions when you guys were talking about Kyle. I don't know if you wanted to open up to the
Let's go ahead and ask yours first, and then we'll open it up here in a couple of minutes.
Yeah, I think a couple of things, and you guys hit it on a little bit, was our retirees. That's a big question of, we see their tax return and all, the only income they have is a pension or a Social Security. And I think, that's just probably the first question, is that treated the same as earned income from W-2 from a employer? And the second question would be, well, if they don't have, if they're deferring Social Security in their mid 60s and they just have portfolio income, once again, it sounds like you answered that as well, but maybe talk through that again. If I'm a 65-year-old retiree with, no earned income, how do I qualify for that second home mortgage based on my assets at Klaas or a similar firm?
Excellent question. We deal with that, I won't say every day, but probably every week, somebody's in that situation. So first of all, Social Security income does count as earned income. For us, we look at that. Depending what their overall gross earned income is, will dictate whether or not we can even gross up their Social Security. Because if you're not paying tax on your Social Security income, we can gross that up 25% more. So if it's $1,000 Social Security check, we're going to look at it as $1,250. All right. So, and then pension also counts as income. So we're going to take pension, we're going to take Social Security. So for simple math, we'll say those two numbers are $2,000. All right. But let's say you need to earn at least $3,000 to qualify for this money that you want for this Florida house. Then we're going to take the next step we're going to do is we're going to say, all right, let's look at your assets. What do you have for assets? And whatever you need to qualify for the loan, we'll back into it. So we'd say, Nate, they need to at least have $840 a month a monthly distribution of $840 a month to qualify for this loan. We'll tell Nate the number, and then you guys will talk about it. If that makes sense for you, that works. Just remember that $840 a month times 36 months. The value of your portfolio has got to exceed that number, okay? So as long as it exceeds that number, then it counts as income. And then we're going to underwrite it just like we would any normal person who goes to work and gets a W-2 at the end of the year.
Good. Yeah. So yeah, that's interesting with the taxability of Social Security, because Kyle and I run into that a lot where, you know, that may be their 80% of their income, and on their tax return, only 20% of it's taxable. You know, so that's interesting to hear you say that. One other question on that would be, Chip, we talked about this with a mutual client, someone who's self-employed and maybe recently switched over to a 1099 self-employed income. You know, how would that be different from somebody that gets a W-2, you know, that has a LLC or an S Corp or something, and, you know, has income flowing through that way? Would that change anything for underwriting?
That does. That's another great question. And we run into this one a lot. So if you're 1099 or self-employed, the general guideline is we need a 2-year history of that. Okay. So we can look at tax returns. Sometimes we can add back depreciation. So there's different ways to look at self-employed income. And another thing that might come into both of those last two questions, James hit on it earlier, asset depletion. So we can look at the asset, not necessarily pulling it out, but there's an equation we can run that shows you have enough asset to cover potentially the mortgage payment that you're looking at, or the change in mortgage payment that you're looking at. So self-employment, generally want to see a 2-year history of it. They've actually, surprisingly, even before all this hoopla that's happened in the last couple months, they've started easing up on self-employment again a little bit. They used to get really sticky and want to see P&Ls and all this. So I think they're not only just lightening the underwriting on it, but discovering that it's more viable than meets the eye. There's even some programs that are creeping back that use bank statements. So maybe you show, hey, I have self-employment, but I write off stuff, but I can show $10,000 a month that's going into my bank account. That's another way to attack it. So there's a lot of options, and the idea is to look at the full picture and pick these out and see. Usually a couple of them will rise to the top, and then you can explore those and see if it makes sense.
A couple of things that you could add to that would be a Section 179 deduction, for example. You're a small business owner and you had to buy a dump truck, or you're a consultant and you bought a new Tahoe for your consulting business. All right. Well, let's say your net income was $100,000, but you wrote off that $80,000 Tahoe. So now all of a sudden we can add that depreciation, as Chip mentioned earlier. We can add that back and we say, well, your net income would have been 180 if you wouldn't have bought yourself the Tahoe. So then we're going to use that from an underwriting perspective. Number two is, if you've been self-employed for 5 years, and let's say 1 year you just kind of lost your shorts, so you wrote a lot of stuff off, we could do just a 1-year tax return as long as you can verify that you were self-employed for 5 years. That is a loan product that Freddie Mac offers, but Fannie Mae does not, and they're kind of like kissing cousins. Fannie and Freddie are similar but different. Fannie's the big shot cousin, the superstar athlete, and Freddie's kind of like, the science nerd. They're a little bit more technical. They have some really niche products, but they're both guaranteed sponsored enterprises.
Good. All right. Well, I will open it up for some live questions. So if anybody would like to ask a live question, go ahead and I will allow everyone to talk. And if not, I will just start closing us out here. So everyone should be able to talk. You might still be on mute. So if you want to unmute yourself before you ask a question, that would be great. And then we can have James and Chip answer anything live for you. Nothing yet? Go ahead. Sharon, are you there? Did you have a question?
Okay. My husband will ask something, I think.
Okay.
Hi. We are Well, I guess I am interested in more of the details of the reverse mortgage for older people that have equity in their homes.
Great. So a reverse mortgage is definitely an option that should be discussed with your financial planner because they have strong, there's two schools on this. There's the love them and there's the hate them. So depending on what school of investment philosophy you adhere to, we can kind of speak to that. So I think maybe if Kyle or Nate have an opinion, that'd be great.
Absolutely, yeah. So typically, we're not huge fans of reverse mortgages. James and Chip know this. They're not nearly as bad as they used to be. They've made a lot of changes over the years that have made them a little more tolerable. We would still view them as probably an absolute last resort when it comes to, if you've depleted the rest of your assets and you still need extra money to live on, then maybe it's something that we consider, but it's not something that we would say, you do right off the bat while you still have a nice portfolio and all that kind of stuff. So does that help line that out for you, James?
We have a disabled daughter and we're considering adding on like a small in-law suite to our home.
Okay.
So that's what we were thinking about. Well, would a reverse mortgage help to do that?
Or just get a refinance somehow.
Yeah, so this would get into more technical financial planning. Is the house completely paid for and that kind of stuff
No.
too, or do you still have you said no? You
It's
still have a little money down?
probably in the neighborhood of 165,000, and we owe about 60.
Okay, so there's a little bit of equity there. So yeah, this is kind of off the cuff because I don't know the rest of your guys' situation, obviously, but we would definitely want to look at maybe exploring either like a home equity loan or a refinance before we went the full reverse mortgage route, I would think. But
Okay, well, the Rockford office has our paperwork and everything. They're handling my wife's IRA.
okay,
401.
okay. That's something. Go ahead, James. Put some more color to it if you don't mind.
So, Mr. Peterson, there is a loan product out there. It's called it's Fannie Mae Home Style Renovation Product. And I think that would be a better situation for you. It's not a construction loan, but it's not really a home equity loan. It's like, hey, here's our house. It's worth $165,000. We owe 60. We want to put an accessory dwelling unit on for our daughter, or we want to put an addition on for our daughter. Most people call that an accessory dwelling unit. All right, so you would get somebody to draw up some plans. They'd say, okay, here's the plans how we're going to add on to our house. Then we'd have a builder say, okay, it's going to cost $65,000. So what we're going to do under this loan product, it's an excellent loan product. We're going to look at it like, what's the house worth when it's done? So let's say you put this $65,000 addition on. So, and let's say after you put this addition on, the house is worth $300,000. That's how we're going to determine lending for. So then we're going to say, okay, when this house is finished, it's going to be worth $300,000, but he needs 50 grand or 60 grand to build it now. So we're going to do that loan now. We're going to pay the contractors while they build this addition, and that's how you fund an addition for a situation that you're in. It's the best, in my professional opinion. That would be the best route for you to go.
It sounds like it. Thank you.
Yes,
And that's a great product, and I think it just begs to it's something that needs to be looked at and defined. Hey, is the home style right? Is just maybe just a straight refi? We just don't know, but it's definitely a time to do a little mortgage checkup. It sounds like.
Yeah.
Okay.
And definitely, if you didn't get that, stay away from the reverse mortgage for what you're talking about.
Sounds like a much better idea. Thanks a lot, guys.
Absolutely.
You.
We'll get your guys' contact info, and we'll if you guys are okay with it, we'll give it to James and Chip, and they can touch base with you a little bit more if that's okay.
Sure.
Oh, absolutely.
Okay. Perfect. Great. Thanks for the question. That was a good one.
Thank you.
Anybody else? No. Doesn't look like it. Well, great. Well, for those of you that have been clients of ours for a long time, you know that we are generally, we try to stay away from debt, but there are certain situations where it makes a ton of sense. I'd like to echo what James and Chip said, especially when it comes to second homes. We have so many clients say, oh, can I take this out of my IRA and just pay cash for the $600,000 house or $500,000 house? We're probably not going to suggest that very often because remember, anything coming out of an IRA is taxable. So we don't like paying interest if we can avoid it, but sometimes it's a heck of a lot cheaper than paying taxes on a big distribution or something like that. So all of this stuff with all financial planning is all individually based on your situation, and everybody has different moving parts. So it's making them all work together so that we can accomplish whatever goals you're trying to accomplish. So,
Okay.
all right. Well, I think that's everything that we wanted to cover. Any last thoughts, James or Chip or Nate? No?
I just want to say thank you. I know for those who participate today, just to take, an hour out of your day and listen about financial literacy is really important. We need more financial literacy, in our country. And if there's ever any questions, you don't have to wait for the next webinar. You can reach directly out to Chip. His contact info is, I think, on the website, and he'd be more than glad to answer any questions. If he's not available, I'm also available to answer any questions, but we just want to be able to serve you, serve your family. If you have a child or a niece that's thinking about buying a house and they're not sure, it doesn't cost anything just to talk about it. We don't charge for pre-approvals. We don't charge for advice. We want to lead with a giving hand, and that's how we've just kind of ran our business for over 20 years. So thanks for your time today, everybody.
Thank you.
Thank you.
Yeah, thanks everyone. So we will post this recording on our website at some point for those of you that would like to rewatch it. And as James mentioned, Chip and ProVisor's info is on our website. They're part of our what we call Klaas Trusted Partners program. So you can see all their contact right on our website. But like we said, we will get in touch for you, the Petersons, and we'll get their contact info over to you.
Thank you.
All right. Well, thank you, everybody. Enjoy the rest of the evening here. And I think we're finally into spring. I don't see any more snow in the forecast, at least. So that's good. Thanks, everybody. And we'll be doing these in the future as well. So we look forward to catching up again. Thanks, guys.